Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 22nd of June 2021, and we're looking at a Forbes article highlighting a potential victim of the Reddit Robinhood GameStop short squeeze, resulting in a fund closing down. And what this could mean for those thinking of investing, whether it be in equities or cryptocurrencies or any other asset class, in the future. So let's take a look. When we saw this article, we really thought we should share it with you because it provides us with quite an important basic lesson that perhaps in the past we in the investment community didn't even anticipate. Headline: Forbes, 22nd of June. London-based hedge fund closes after betting against GameStop, becoming one of first meme stock casualties. By Robert Hart. A London-based hedge fund that took on heavy losses betting against GameStop in January has closed its doors, the Financial Times reported Tuesday, becoming one of the first casualties of retail traders piling into unpopular or heavily shorted meme stocks that saw some financial mainstays lose billions. White Square Capital will close its main fund this month after a review raised concerns over the viability of its business model. Head Florian Kronewitter wrote to investors, the FT reported. Kronewitter said the decision was related to thinking the equity long-short model is challenged. The FT reported, a strategy where traders bet some stocks will rise over time, i.e. long, while others will fall, i.e. short. White Square was one of numerous funds to take on double-digit losses on the short part of this model in January, as armies of coordinated retail traders targeted stocks, including AMC Entertainment and GameStop, that mainstream financial institutions had bet against, known as short selling. A person close to the fund told the FT the fund had made back a fair share of the losses and the decision to close was not related to the meme stock rally. Nevertheless, White Square is one of the first funds hit by the meme stock rally to close, though a number of financial heavyweights, including Wall Street's Melvin Capital and Light Street Capital, suffered heavy losses on short positions in the surge. White Square did not immediately respond to Forbes' request for comment. In explaining his reasoning to investors, Kronewitter said, there are way too many fish in the pond with the same strategy to pursue a long-short model. The traditional edge of hedge funds has been eroded by an oversupply of capital, he reportedly added. Trading platforms like Robinhood have made investing, typically the purview of financial institutions, more accessible to the general public. The strategy and attitudes of these retail traders, many using Reddit forums to inform their trading, also differs from more traditional institutions, which balked as thousands piled into seemingly nonsensical stocks, sometimes in a concerted bid to drive out and penalize Wall Street mainstays. Meme companies included the bankrupt Blockbuster, GameStop, BlackBerry and AMC, which soared to sky-high valuations. Fading interest saw prices for meme stocks plummet weeks later, though there has been sporadic interest in meme stocks since, including another frenzy in June. This gives us a number of potential lessons. We remember as young bankers back in the late 70s, early 80s, before, if you like, the Thatcher Revolution, that the public investing in stocks and shares was relatively limited to a large degree, quite frankly, by the wealthy and those perhaps professionals in the know. This changed with the whole Thatcher Revolution and the concept of privatization, where people started to get involved in purchasing shares in companies like British Telecom, British Gas, various water companies. And made considerable profits compared with the price that these stocks were sold to them. And this generated a popular move towards equity investment rather than it being the purview of the rich and the well-educated in financial services. However, at the same time, we often received, particularly when the over-the-counter market started to gain steam, tip sheets delivered initially by post to our door, and then as internet started to develop, into our email boxes recommending the next share to buy, or we were telephoned by someone in a trading room, basically scamming us in many cases, encouraging us to buy shares in an unknown stock which was going to skyrocket to the moon. And I remember even getting caught up in some of these stocks and losing money. Also, a few which made money, but by far the majority lost money. And this is what, to a large extent, led to my personal sort of cautious approach to equity investment, and focusing mainly on blue chip companies, and perhaps those companies showing progress but with very good management and financial backers, thereby leading to a greater likelihood of success long term rather than a quick short-term scalp. And this went moderately well for a number of years, but we still had the traditional 7-year crash. But in the last few years, there's been somewhat of a change. And it is to some degree due to a cult of personality and an improvement in communication and the creation of online platforms, now available on everyone's smartphone, which when I was a young man did not exist. And today we're also seeing adverts because we're all watching YouTube, or hopefully we're all watching YouTube, otherwise we won't get any viewers. And they're seeing kids, as I call them, making millions allegedly, and showing you, giving you courses on how you can do so as well. Now, I won't go down that particular route, but clearly, if you can make millions trading stocks, why the hell would you want to teach that to somebody else? Quite frankly, you do it yourself, make the millions and have a lovely life. But what is occurring today is, whereas the likes of Warren Buffett, to a large degree, and his ilk would purchase stocks primarily for the long term based on fundamentals, good management teams, good potential, the right sectors, etc., 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 growth sectors, we now have people buying and selling shares and more recently cryptocurrencies based on rather, shall we say, superficial issues. In the crypto market, Dogecoin or Dogcoin gained enormous attraction, and you saw the coin rise thousands and thousands of percent literally in weeks, because it had a picture of a dog, and there's another one called Shiba Inu, because some of these sites are promoting them. YouTube video creators are saying these are going to the moon, and often they do, but they equally come crashing down. Now, this is what's been happening with the likes of GameStop and AMC, because the Robinhood platform, and we have, to be frank with you, covered this in previous videos a few months ago, have attracted a huge set of individuals back into the investment market, everyone wanting to become multi-millionaires, if not today now, billionaires. The effect of that is that you have a market, rather than being based on fundamentals and serious prospects, just based on temporary popularity. That said, of course, we also have to bear in mind a degree of manipulation by the experienced traders. And let's be blunt about this. Those shorting the markets or going long are, in essence, to a large degree, if they're large enough an institution, are affecting the price of the underlying asset, thereby causing that asset to fall or rise, depending if they have a short or a long, and then buying back or selling the asset at the end of that contract very often at a huge profit to that institution. And this is where these young whippersnappers, as we call them, now attempt to prevent that from happening by doing the reverse. So whenever they see a whale in the market shorting the markets, they then come in and tell everyone to buy those stocks, thereby causing those whales to lose huge sums of money. But there is a problem with this. Because when those kids then have purchased those stocks, they have to sell them. And when they start selling them, the price of those stocks then plummet again. And as a result, many of them in turn will lose quite serious sums of money. Now, not as much as the big whale will lose as a single entity, admittedly. But very often these whales can survive the losses, which is why it's quite rare to see a fund or an institution close based on tackling these upstarts in the new financial era in which we live. Which is why we've mentioned it today. It's also to highlight that we shouldn't always believe everything we see on YouTube, or in the papers for that matter, or on the news. And also we have to bear in mind that whenever we're looking at investing, whether it be in equities, gold and silver to some degree, although that market is left alone more to the inverted commas professionals, but whether you're investing in equities generally or cryptocurrencies in particular, we have to be aware that a fad, market fad, can cause prices to rise, but they can fall equally as quickly. But it's something to bear in mind whenever we're thinking ourselves of buying, selling, or shorting or going long on these investment assets. Of course, the purest gold and silver owners will say, own the physical, and you avoid all of that nonsense, which you do. But equally at the same time, let's be blunt about this, you also pay a premium for that privilege. That's it. Wanted to bring that to your attention. Hope I didn't rabbit on too long, but it's an investment issue that future investors have to at least take account of. Thank you so much for listening. If you like the video, please give it a thumbs up. Subscribe if you haven't done so, and certainly press the bell button, just so that you're notified of our videos as and when they're published. And a few hours ago, we published our Tuesday morning update, and yesterday an interesting podcast, Should You Buy Gold? And we've put links to all of these below. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.